Yo, what's up everyone? It's your boy Looney back with another breakdown. Volatility in 2025 is creating insane opportunities. And today I'm going to show you how to profit from it using option strategies that actually work. Before we get into it, quick shout out to my Discord community. I have a free section for anyone, and then I also have a premium version, $8 a month, and it's where I drop trade alerts, exclusive option plays, and in-depth strategies. If you want to see exactly how I trade these setups, links are in the description. Check it out now. Let's talk about volatility and how to trade it. When the market is wild, people panic, but we can use options to make money off that panic. Let's break down the 3 strategies that work in volatile markets. I'm showing you VIX right now because this is an index. It's the volatility index, and it tracks how volatile the market is. And when it's above that $15 point or 15, it is considered higher volatility. It's not necessarily that high. It's when it goes past 20 is when it's its highest volatility. So you clearly see the volatility is a bit high on the higher end. So this creates opportunities, and that's what we're going to get into. We're going to show you 3 strategies. Number 1 is selling puts. I just sold 2 cash secured puts on Riot because it was trading near the lower Bollinger Band. When the stock hits that lower Bollinger Band or lower band, they often rebound, and selling puts is a great way to profit while getting paid to wait for potential bounce. Let me just show you guys this real quick and what exactly I mean. And I actually give this trade out to my Discord community, and this is an example of what kind of trades I'd give out there. Now, I noticed Riot yesterday on Sunday night, or just kind of everything dropped, and it fell below that lower Bollinger Band. And usually when that happens, it ends up spiking back up immediately because Bollinger Bands are based on standard deviation, meaning stocks tend to stay between those 2 Bollinger Bands 95% of the time. And when it goes below or above that Bollinger Band, it happens about 5% of the time, and it ends up quickly reverting back to that mean. And that's exactly what happened. I noticed last night it was leaving, and then this morning I tried to catch it at its lower end. I think I bought into it at just about the middle, which is still okay to sell cash secured puts. Obviously, you'd want to sell it when the stock is undervalued, but it is still a good time to sell cash secured puts. And I collected that premium, and I netted a premium of 160, I believe. I did 2. So let me just pull that one up again. You can see it was 67 for the 2, or for 1, and then for the 2 it was 130. And that goes straight to my buying power. And I could hopefully make enough to start doing this again on either the same stock or a new one. Number 2 is covered calls. And this is generating income in a choppy market. If you end up owning the shares, selling covered calls can hedge downside risk and also generate consistent income. If a stock trades sideways or slightly down or slightly up, you still get paid through option premiums. You could clearly see I'm running covered calls on NEO, Riot, and Mara, just to name a few. And I collected premiums up front, as you always do when you sell options, but I'll net profit if the stock stays below that strike price. And if Mara on expiration stays below that $20 spot, I net profit at 367. And I get my shares back, and I could run the covered call again. And although the stock is volatile, it can go past $20 very easily in 1 day notice. I am okay with that price point because I can either sell off the shares at $20 and net that profit, or I could roll into a new position, which I usually do if it goes above the strike price. And then also you could buy to close. I don't generally buy to close, but that is an option for anyone to do. And I'll show you an example. This Riot $12, it is actually in the money, meaning the stock is trading above that strike price. And if it stays like this till expiration, I'll be forced to call away my shares, meaning I'm forced to sell them at $12, which isn't really a bad thing. I'll still net profit. I'll sell them for $12 a share, and I'm only missing out on that 4 cents But then also remember, I get premium when I first open this trade. So I'm not really missing out. I'd be missing out if the stock was trading above the break even. So if the stock goes all the way past $14, that's when I sort of miss out on potential gains. But if it stays like this, what I'm going to end up doing is just rolling it into a new position, collecting more premium. You either have to pay a little bit to roll, or you get paid a little less when you roll. I'm okay with either. I'm okay with that, just missing out for like a month or a few months. It's not that big of a deal. You're still getting consistent returns. Number 3 is sort of combining the two. And I can't actually do this because I don't have option level 3 trading, and it's called iron condors. And this is good for when the market stalls. So when volatility is high, premiums on both sides, puts and calls inflate, making iron condors a perfect strategy. You basically sell a put spread and a call spread. They're both it's a put credit spread and a call credit spread at the same time. And you're expecting the stock to stay within that range of strike prices. And this lets you collect premium from both sides without needing a huge market move. And put credit spreads and call credit spreads are very similar to cash secured puts and covered calls, which I just explained. And you're basically betting that the stock stays within that range. So I'm not going to be able to show you in this video because I don't have that availability, but I can show you sort of how it would play out in the situation I have right now. So I have that Riot $12 call, and then I have the Riot $10 put. So as long as the stock stays between that number, I get the maximum profit. If it ends up trading outside that area, I either get less profit, or if I go past the break even, I start to lose some money. But your gains and losses are maxed out. There is no unlimited risk. So it is a good strategy if we're growing portfolios. I wouldn't use it as much as the two I've mentioned before. The other two are a little bit more consistent and can help you build your portfolio, but iron condors are good when you see the opportunity, and that's when you see the market is kind of stalling and moving sideways. And especially when big moves already happened and volatility is expected to cool down. Final thoughts are volatility creates opportunity. Instead of panicking, you can sell puts for premium, run covered calls for income, and use iron condors when the market stalls. I could have sold off at a loss all my crypto yesterday, and all my stocks were down just yesterday. And they recovered very quickly. And I just kind of sat it out. I let it be. And I also capitalized on that opportunity. I did a cash secured put because I knew a bounce back could happen. And if it kept dropping, I got hedged by my covered calls. So let me know in the comments, are you trading options in this market? Also, if you want live trade alerts and breakdowns, join my Discord. Links are in the description. Like, subscribe, and let's keep making money in 2025. Peace.